Good afternoon. I'm Dannae Delano, and together with my partner, Roberta Casper-Watson, we're here today to talk about new guidance for employers in the health and welfare plan arena, specifically the COBRA subsidy and the DCAP changes under the American Recovery Plan Act. But before we start, just a little bit of housekeeping and a little bit about us. We invite you to ask questions throughout the program by utilizing the WebEx Q&A feature on the bottom right-hand side of your screen. We will try to answer your questions throughout the program, but we'll also try and reserve time at the end of the program to answer any questions that have not yet been answered. We are recording this program and it will be available on our firm website sometime after the program ends. If you would like a copy of the PowerPoint presentation, please send me an email at ddelano, so 2 Ds, E-L-A-N-O, at wagnerlawgroup.com, and I will send you a copy following the program. Roberta and I are both experienced benefits lawyers with the Wagner Law Group, and we are both members of the firm's Health and Welfare Practice Group. We co-lead the firm's HIPAA Privacy and Security Practice Group, and Roberta leads the firm's Health and Welfare Practice Group. We are both experienced in areas of ERISA and employee benefits with a focus on pension and profit sharing plans, as well as health and welfare benefits, including COBRA, HIPAA, and the Affordable Care Act. Roberta also concentrates in fiduciary decision-making and employee stock ownership plans, and I have extensive experience with employee benefits and mergers and acquisitions, as well as correcting qualified retirement plans in the various voluntary corrections programs. I will now turn it over to Roberta to start our program.
Okay, thank you, Dannae. Can you advance to the first substantive slide, please? Congress decided that during this pandemic, it wanted people to be able to keep their health insurance in place as much as possible. And so they used a technique that had been done in 2009 in terms of having the federal government subsidize COBRA premiums. In 2009, the subsidy was only partial. I think it was about 60%. This time, the subsidy is 100%, and that creates some interesting differences for the current rules compared to the old rules. But we want to talk about some of the basics. This is really important because there's a notice that employers are going to have to send to people who are eligible for the subsidy or who are or might be eligible for the subsidy by the end of this month, which is coming up very soon. And so we wanted to provide some guidance to our clients and friends as to the details of these rules, so that you can be in a position to at least know what to ask in order to make sure the notices go out. Hopefully your COBRA administrators will be doing the work, but you'll need to supervise them to make sure that it's happening right. There's a very specific assistance period. It's April 1st, 2021 to September 30th, 2021. And that's the period during which this subsidy will apply. Now, so far, that's the only period during which it will apply. Congress, of course, could extend the period should it decide to do so. It would take Congress, though, to extend the period. The administration can't do it by itself. So somebody who is eligible for the assistance, they can get it now retroactive to April 1st if they meet the other eligibility requirements. It will expire, the subsidy will expire by September 30th. If earlier, the subsidy will expire on the expiration of their COBRA period. Now, this expiration date, their eligibility for the subsidy will continue or can continue if they have a disability extension or a second qualifying event, as long as the first qualifying event was one that would entitle them to the subsidy. Also, it will terminate an individual's eligibility for the subsidy will terminate if the individual becomes eligible for disqualifying other coverage. Note that it's not enrolled in disqualifying other coverage, it's becoming eligible for. The subsidy is only for those who aren't eligible for anything else. Also, the plan must be subject to COBRA or state requirements in order to qualify anybody for the subsidy. If if a plan is not subject to COBRA but is voluntarily providing it, that isn't enough. The assistance percentage, as I noted earlier, is going to be 100%. So those who sign up for the subsidy will get it completely free. And the idea is that the government will end up paying it. Dannae, the next slide, please. Okay, who's eligible for the subsidy? And the term in the statute is assistance eligible individual. Somebody, in order to be an assistance eligible individual, or an AEI, that's shorter, must be eligible for COBRA based on one of two things. And being eligible for COBRA based on something else doesn't count. You have to be an AEI. I mean, you may still be eligible for the COBRA, but not for the subsidy if it's a different event. An AEI is eligible for the subsidy if there was a reduction in hours. So if they lose coverage based on there being a reduction in hours. So, for example, if the employer, if the person goes from a 40-hour a week to a 20-hour a week, and that means they lose coverage, then that's a reason to be eligible for the subsidy. And that's true even if it was the individual's own idea to reduce the hours. This category includes people who go on leaves. It includes things like strikes, as long as regular coverage is lost. Pretty much any reason for a reduction in hours, again, even if voluntary, will entitle the individual to the subsidy as long as the other requirements are met. Interestingly, the death of the employee does not constitute a reduction in hours or an involuntary termination of employment. The second category, besides reduction of hours, is an involuntary termination of employment. Now, it includes a termination for cause, although not if it's for gross misconduct. If you terminate somebody for gross misconduct, they're not eligible for COBRA at all, and thus not eligible for the subsidy. But short of gross misconduct, any termination that is employer induced will qualify the individual for the subsidy. And this is interpreted by the new IRS guidance as it is interpreted very broadly. It includes things like resignation for good reason, a termination where the employer makes what we call a constructive termination, where the employer changes the terms of the individual's employment so that it just isn't the same anymore, and if the employee terminates for that. It does not include retirement unless the employer invited the employee to retire, basically indicated that the requested the employee to retire. So any situation, even if formally the employee is the one that takes the action, if the employer induced it, that will constitute an involuntary termination of employment. However, if the employee, for the employee's own reason, decides to terminate employment, then the mere termination of employment doesn't entitle the individual for the subsidy. It'll entitle the individual to COBRA, but not the subsidy. Incidentally, loss of child care is not an involuntary termination of employment, so that the termination, in order to be eligible for the subsidy, the instigation needs to be employer based, even if the employee sort of had no choice because of circumstances. If those circumstances aren't connected to the employer, then that won't count. Of course, a termination for childcare, if instead of terminating for childcare they go on leave, that might end up being a reduction in hours. So It's a little complicated, and employers need to be really careful. The Department of Labor is on top of this. One of our lawyers has already gotten a call from somebody at the Department of Labor based on a way that a client was thinking to handle the subsidy, and the department, somebody complained to the DOL, and the department didn't like what the client was trying to do. And so the DOL is on top of protecting people's rights to get the subsidy. The assistance eligible individual needs to elect COBRA, and many people may have their election periods still going on because of the prior action of the Congress and the agencies to extend the election period because of the pandemic. So they have to elect COBRA, and it includes the assistance eligible individuals include both the employee who has reduced hours or had an involuntary termination, and also the qualified beneficiary dependents of the individual who was terminated or had the hours reduced. So it's very broad, and very, it's going to be it's going to be very important for employers to be careful, because basically the way it's going to work is the employer gives free coverage to the individual, and then the employer files with the IRS to get the money. And so you don't want to be in a situation where you've given the free coverage, but you don't get the money from the IRS. On the other hand, you want to make sure you give the coverage to everybody who's entitled to it. A person can be an AEI more than once if there are, say, two separate terminations involved. A person might come back to work and thus become re-eligible for regular coverage and then terminate again, or there might be two successive jobs during the relevant period, so you can be an AEI more than once. Logistically, the employers will end up having the individuals self-certify to their eligibility. An employer generally will know whether an employee has had an involuntary termination or a reduction in hours, although there may be circumstances where the people administering the COBRA don't know that, in which case the individual will need to self-certify it. In terms of whether the individual is eligible for other coverage, the individual will generally need to self-certify to that. Now, if the employer knows contrary facts, then the employer can't rely on the individual's self-certification, but otherwise the employer is allowed to rely on that. And presumably, the guidance doesn't say this, but presumably an employer can't just turn a blind eye and say, I don't want to know something, and decline to ask. Next slide, please. Now, since eligibility for other coverage terminates the eligibility for the subsidy, and the plan won't generally know what the circumstances are in terms of eligibility for other coverage, we have to rely on the individuals to notify the plan when they become eligible for other coverage. And so there's a penalty in the statute for somebody who fails to do that. The basic penalty is $250 for each failure to notify. However, if it's intentional, then the penalty is the greater of $250 or 110% of the premium assistance that was improperly provided. So that penalty could be pretty stiff. Hopefully, it will induce the individuals to tell the truth when they become eligible for other coverage. An important issue: an individual is not allowed to have both the subsidy and the health care tax credit for the same period. Coverage by the exchange is not disqualifying other coverage. So an individual could have an exchange policy and still be eligible for the subsidy. However, if the individual's exchange policy is being paid for by the healthcare tax credit, then the individual has to give up the healthcare tax credit for the period during which the individual is receiving the subsidy. Next slide, please. Okay, what is this disqualifying other coverage? As I said, the eligible individual must notify the plan if he or she becomes eligible for the disqualifying other coverage. The other coverage includes basically any other group health plan coverage other than certain minimal coverages that are considered not to disqualify the individual. Something that is only accepted benefits, like a dental or vision plan, or something that is only a flexible spending account, like a health flexible spending account or a dependent care flexible spending account, those won't disqualify the individual. Also, a QSERA, a device for small employers to reimburse individuals for their own health policies, those won't disqualify the individual. Also, if the individual has other COBRA coverage, that won't disqualify the individual. But other than that, coverage under a group health plan, that other than the COBRA plan, will disqualify the individual. For example, if the terminating employee is eligible for coverage under the spouse's plan, just the mere ability to be covered under the spouse's plan will disqualify the individual, as long as the individual is eligible to enroll in that other coverage. Now, if the open enrollment period has passed and there isn't any current right to enroll, then the fact that the individual could have signed up for that coverage won't disqualify him or her. But once there is an opportunity to enroll, then if the individual fails to enroll, that will deny the individual the subsidy. And a termination generally would be a special enrollment event under the spouse's plan. So so people whose spouses could cover them probably generally won't be entitled to the subsidy. Also, eligibility for Medicare is disqualifying other coverage, and it's mere eligibility for. It takes enrollment in Medicare to terminate your COBRA rights in general, but it only takes eligibility for Medicare to terminate your subsidy rights. Next slide, please. Okay, the coverage is only disqualifying if you're eligible to enroll at the relevant time. Like if you weren't eligible because the open enrollment period is closed and it's not a special enrollment event, then you wouldn't be eligible until such time as enrollment is available to you. But note that the general COVID extension on a lot of things may have kept open enrollment periods open if they were based on some kind of special open enrollment, like if there was a marriage. If there was a marriage in October and they didn't enroll the spouse yet, but the ability to do that is still open because of the COVID extension, then that would constitute disqualifying other coverage. It's only disqualifying if it's available to the individual on or after April 1st, 2021. So if they had prior coverage and dropped it, and they're not eligible to re-enroll because they dropped it, then that won't count against them. There's a tough dilemma that I'll try to explain very quickly. Basically, eligibility for a major medical plan is disqualifying other coverage, and that's true even if it's only a dental or vision plan that you're dealing with. And so that's going to create a dilemma. some people are saying that this should be interpreted as you're only disqualified from dental if you're eligible for other dental, only disqualified from major medical if you're eligible for another major medical plan. That's not how the statute reads. Basically, basically dental or vision coverage, which are accepted benefits, don't disqualify you from anything, but eligibility for major medical disqualifies you from everything under a literal wording of the statute. There's guidance in the recent IRS guidance that says that if a single employer offers a package with the major medical, dental, and vision, and basically none of those, choosing one of those or eligibility for any of those won't disqualify you from anything else that employer has. But say you're eligible for your spouse's major medical, but the spouse's employer doesn't have dental or vision. The fact that you're eligible for the spouse's major medical technically would disqualify you from the subsidy for your own employer's dental or vision. Next slide, please. As I mentioned before, coverage through the exchange is not disqualifying, but the individual has to choose whether he or she wants the subsidy or the healthcare tax credit. Retiree coverage is interesting. Under the IRS guidance, it's not your eligibility for retiree coverage instead of COBRA is not disqualifying if it's all under the same plan as the COBRA plan. But if you're eligible for retiree coverage under a different plan, whether it's of the same employer or a different employer, then that will be disqualifying other coverage. Next slide, please. In general, the subsidy covers. In general, the subsidy covers the same coverage that the individual had before the qualifying event occurred. Under COBRA, of course, you may have rights to choose another option, and the subsidy will cover the other option if the employer chooses to make it available to you, and if it doesn't cost any more than the option that you were covered in before the qualifying event. So the employer gets to choose whether to offer you a choice between between the coverage that you had and another option, and that's okay. And the subsidy will apply to the other option, but it won't cover any increase in premium that results from any change. The other option cannot be solely accepted benefits, however, or it cannot be a QSERA, or it cannot be a flexible spending account. Next slide, please. Okay, in order to facilitate the subsidy, there's an extension of the election period because many people whose COBRA periods are still open, the qualifying event will have happened some time ago, and they may well not have elected COBRA coverage. There's a special election period now that gives them the right to do so, and it'll give the employer an obligation, of course, to give them notice, and that's the notice deadline that's happening the end of the month. The individual will have a right to elect COBRA starting on April 1st without regard to any pre-April 1st period during which there was eligibility for COBRA, or the individual can elect COBRA retroactively to the date that the individual was first eligible for COBRA. Now, if the individual elects retroactive coverage, then they're on their own for paying the COBRA premium for that. But if they elect it only starting April 1st, then if they're otherwise eligible, they'll get it paid for by the subsidy. And this special election right is available if the individual could have elected COBRA but didn't. And of course, COBRA election periods are still open for up to a year because of the COVID extension. So you know, somebody who could have elected COBRA and didn't may have this extension. Somebody who was on COBRA for a while and dropped out for failure to pay premiums. Any of those can still take advantage of the special election period. And the extended period then will be from April 1st. The extended election period will be from April 1st through 60 days following receipt of notice of their extended election rights. I think the drafters of the statute contemplated that some employers might have trouble getting the notice out within that first 60 days, especially since we only got the IRS regulation or the IRS guidance a week ago. And so if you miss the 60-day deadline, then that gives the individual more time. The individual will have a full 60 days following receipt of the notice of the extended election rights to make the choices. Next slide, please. It's kind of complicated to coordinate this special election right with the COVID extensions. Incidentally, the COVID extensions do not extend any deadlines for purposes of the subsidy. So the 60-day deadline that employers have to give the notice is not extended by the COVID extensions, and employee decisions are not extended under the subsidy, are not extended by the COVID extensions. But some other things may well be still open. For example, the need to pay the COBRA premium for pre-April 1st periods. That may still be subject to the COVID extensions, and any COBRA rights that the individual has after September 30th will be subject to the COVID extensions. Now, if somebody chooses the subsidy without choosing retroactive COBRA, the right to choose retroactive COBRA will be lost. But if retroactive COBRA is chosen, the premium for the retroactive COBRA won't be due until the end of the COVID extensions. So somebody may choose retroactive COBRA and not pay for it yet and start getting the subsidy, and you have to provide it for the subsidy period, and it'll be kind of complicated to administer. I mean, COBRA generally requires that you pay the premium before the plan starts paying claims, and so it could really complicate things for the administrator. Next slide, please.
And that means it's my turn.
Okay.
So, plans and issuers are required to notify all qualified beneficiaries regarding the premium assistance and other information about their rights under the American Recovery Plan Act. A general notice to all qualified beneficiaries who have a qualifying event that is a reduction in hours or an involuntary termination of employment from April 1st, 2021 through September 30th of 2021. This notice has to be provided separately or with the COBRA election notice following a COBRA qualifying event. There are very specific content requirements relating to the required notices. They're set forth on the slide. You can read those right off of there, and they're kind of your typical notice requirements that they have to be in a clear and understandable language and what information must be contained in the notice. The DOL has issued model notices that can be used to comply with these requirements. The model notices are available on the DOL website and have been since March. A notice of the extended COBRA election period to any assistance eligible individual or any individual who would be an assistance eligible individual if a COBRA continuation coverage election were in effect, who had a qualifying event before April 1st of this year. This requirement does not include those individuals whose maximum COBRA continuation coverage period, if COBRA had been elected or not discontinued, would have ended before April 1st of this year. So generally those with applicable qualifying events before October 1st, 2019. This notice is required to be provided within 60 days following April 1st, 2021. So that means by May 31st. So if you haven't done the notices, you should be on top of that in the next few days and coordinating that with your COBRA administrators. Plans and issuers are also required to provide individuals with the notice of expiration of periods of premium assistance, explaining that the premium assistance or COBRA subsidy for the individual will expire soon, the date of the expiration, and that the individual may be eligible for coverage without any premium assistance through COBRA continuation coverage or coverage under a group health plan. Coverage may also be available through Medicaid or the health insurance marketplace. This notice has to be provided 15 to 45 days before the premium assistance or COBRA subsidy is set to expire. Unless specifically modified by the American Recovery Plan Act, the existing requirements for the manner and timing of COBRA notices continue to apply. So due to the COVID-19 national emergency, the DOL, the Department of Treasury, and the IRS issued guidance extending timeframes for certain actions related to health coverage under private sector employment-based group health plans that Roberta was talking about. The extensions under the joint notice and EBSA disaster relief notice don't apply, however, to the notices or the election periods related to the COBRA premium assistance available under the American Recovery Plan Act. So plans and issuers have to provide the notices according to the timeframe specified. The DOL is committed to ensuring that individuals receive these subsidy benefits, so they're going to be on top of enforcement. Employers or multi-employer plans can be subject to excise taxes under the Internal Revenue Code for failing to satisfy these COBRA continuation coverage requirements. And that tax could be as much as $100 per qualified beneficiary, but not more than $200 per family for each day that they're in violation of the COBRA rules. So what are the plans that are eligible for premium assistance? Medical plans, standalone dental and vision plans, HRAs, and Roberta talked about this as well, retiree health coverage if it's offered under the same plan as active coverage, but not if it's offered separately. Not eligible for premium assistance COBRA subsidies are health FSAs or QSHRAs. Also not eligible is coverage with premiums greater than the premiums for the coverage in which the individual was enrolled at the time of the qualifying event, unless that coverage is no longer available or that coverage is elected in the normal course of an open enrollment that occurs during the subsidy period. So if you happen to have an open enrollment during the subsidy period, then an individual could elect coverage that had a higher premium and receive the subsidy for that. So who is eligible to receive and be a payee in terms of the COBRA subsidy? The first one I'm going to talk about are the multi-employer plans. So a group health plan that is a multi-employer plan as defined in 337 of ERISA are an eligible premium payee. The common law employer that maintains the plan in the case of a group health plan other than a multi-employer plan that is subject to federal COBRA or under which some or all of the coverage is not provided by insurance, so at least self-funded in part. And also insurers providing coverage in the case of any group health plan that's not described as a multi-employer plan or an employer plan that we just talked about. And that generally means that it's a fully insured, it's only fully insured coverage subject to state continuation coverage requirements that are going to fall into that category. Premium payee can also include a government of any state or political subdivision, an Indian tribal government, any agency or instrumentality of either of those things, and any agency or instrumentality of the federal government of the United States. So you can have a governmental payee as well. As of the date on which the premium payee receives the potential AEI's election of COBRA continuation coverage, the premium payee is entitled to the credit for the premiums not paid by the assistance eligible individual by reason, or they're entitled to payment of those credits for any periods of coverage that began before that date. The premium payee is entitled to the credit for the premiums not paid for each subsequent period as of the beginning of each period of coverage that they don't pay the premiums in accordance with their election, without regard to when they could have been required to receive the payment of the premium. So if you're going to look at an example related to that, if the COBRA period of coverage is a calendar month with COBRA premium payments due on the 10th of each calendar month, then the employer pays its employees semi-monthly with payroll periods ending on the 15th of the month and the last day of the month. On June 17th of 2021, the employer receives a COBRA election from an AEI who elects continuation coverage as of April 1st, so the beginning of the subsidy period. Then that employer is going to be entitled to a credit as of June 17th for the premiums not paid by the assistance eligible individual for the period of coverage April 1st through April 30th, May 1st through May 31st, and June 1st through June 30th. Assuming that the AEI doesn't notify the employer of other disqualifying coverage or that they're otherwise ineligible, then the employer would become entitled to a credit as of July 1 for the premiums that have not been paid by the assistance eligible individual for the period of coverage of July 1 through July 31. And assuming the facts stay the same and they're not notified of other disqualifying coverage or other ineligibility, it would be the same for August and September. If an employer is entitled to claim a premium assistance credit, then they have to pay the premium to the insurer. So you're responsible for paying it and then getting reimbursed, as Roberta was talking about before. The amount of a credit includes a full 102% of the COBRA premium, like Roberta said before. So in addition to 100% of the cost of coverage, you can also charge the 2% administrative fee that you can charge for COBRA. There is no credit available for any amount that you would have subsidized otherwise. However, the IRS FAQs that came out last week makes it clear that you can amend your plan to increase your required premium and not subsidize it, as long as it follows the normal rules applicable to changing the COBRA premiums and notice requirements for doing so. So if you have traditionally subsidized it and you don't want to during the subsidy period, you can do so, but you're going to have to follow the rules and notice requirements applicable to that. You can increase, like I said, the COBRA premium, even if it provides a taxable severance benefit to an individual, as long as you follow the rules. Like we have discussed, and we've had a question earlier, the premium assistance credit is only available to an employer for the portion of the premium that's attributable to qualified beneficiaries. So it's not going to be available for family members like a domestic partner who don't meet the dependent test. Because it doesn't apply to non-AEI COBRA qualified beneficiaries, there are specific examples in IRS Notice 2021-31, which just came out last week, that has examples of how to calculate the credit where these non-AEI COBRA qualifying beneficiaries are covered through an assistance eligible individual. And because we were asked early in the program, I'm going to go into a little bit more detail on this. The premium amounts for COBRA continuation coverage for one or more individuals who are AEIs and one or more individuals who are not AEIs are going to be allocated first to the premiums for the assistance eligible individuals based on the cost of COBRA continuation coverage without premium assistance for only assistance eligible individuals, and then applied to premiums for the individuals who are not assistance eligible individuals. So if the total cost of the coverage for all covered individuals doesn't exceed the premium cost for the assistance eligible individuals alone, then the premium for the individual who is not an assistance eligible individual is zero, and the premium assistance is the full applicable premium amount of the COBRA continuation coverage. If the coverage of an individual who is not an assistance eligible individual increases the total COBRA premium for all individuals, that incremental additional cost is not considered COBRA premium assistance for purposes of the credit. So some specific examples: if an employee and an employee's 2 dependent children are assistance eligible individuals and have COBRA continuation coverage, but the COBRA coverage also covers an individual who lives in the same household who's not an assistance eligible individual, and the amount the plan requires to be paid for COBRA continuation coverage for self plus 2 or more dependents, which would also include the individual who's not an assistance eligible individual, is $1,000 per month, then the amount that the employee would pay for coverage and for the employee and the 2 children is going to be $1,000 a month. The additional premium amount for coverage of the individual who's not an assistance eligible individual is going to be $0 per month under this example. Therefore, the employee is going to be entitled to apply the COBRA premium assistance for the full $1,000 premium, and the credit that the employer would get, it would also be $1,000 for that month. In a different example, if you have an employee who's an assistance eligible individual who has self-only coverage, that would cost $450 per month, and during the extended election period that Roberta talked about, the plan had an open enrollment period that allowed active employees and qualified beneficiaries to add spouses and dependents to their health coverage. And the AEI who's on COBRA adds the employee's spouse and dependent child who were not covered before their qualifying event to their continuation coverage. Without regard to the COBRA premium assistance, the COBRA continuation coverage for self plus 2 or more dependents is $1,000 per month. So the spouse and the dependent child are not assistance eligible individuals because they were not covered by the plan on the day before the employee's qualifying event. The amount the employee pays for the spouse and the dependent child is going to be $550 per month, which would be the $1,000 minus the $450. And the employee would be entitled to premium assistance with respect to only the $450 amount, and the credit would be $450. So there are very specific examples. They're actually addressed in Q&A-68 under the IRS guidance that was issued last week, which is Notice 2021-31. And if you have additional questions on how to calculate that, we're available to answer those. But it's interesting because anytime you're going to have coverage that covers like full family, you have the possibility of having non-assistance eligible individuals within that premium amount. And so the credit calculation is going to vary based on that situation. So how does an employer claim the premium assistance credit? A premium payee, so it would include also a multiple employer plan or an insurer, if we're talking about that situation, can claim the credit by reporting the credit, both the non-refundable and refundable portions of the credit, depending on what's applicable, and the number of individuals that are receiving COBRA premium assistance on the designated lines of its federal employment tax returns. So this is usually Form 941, which is the employer's quarterly federal tax return. In addition, in anticipation of receiving a credit to which they're entitled, the employer could reduce the deposits of their federal unemployment federal employment taxes, including withheld taxes that it would otherwise be required to deposit, up to the amount of the anticipated credit. And they also can request an advance of the amount of the anticipated credit that exceeds the employment tax deposits available for reduction by filing Form 7200, which is the advance payment of employer credits due to COVID-19. So Notice 21-24, which is an IRS notice that was issued early in the year, has more information regarding the reductions in deposits for the credit and other employment tax credits, because it works like the other COVID-19 employer credits and claiming those, which you can do under different programs. A premium payee or employer can reduce its deposits of federal employment taxes up to the amount of the credit to which they become entitled with regard to a period of coverage as of the date that they're entitled to the credit, as I was talking about before. So you can't claim the credit until you're entitled to payment for it. But you can file it to request advance payment if you are not going to be receiving it or be able to deduct it on your payroll taxes, so you can get it before then. So like I said before, you can't reduce your deposits or request an advance for a credit for a period of coverage that hasn't began. So the situation that I talked about before, when you're entitled to it, is something that becomes very important when you're trying to determine what you can do to claim the credit. If you happen to be an employer that doesn't have employment tax liability, like a multiple employer plan like we were talking about before, then you can claim the credit on the Form 941 for the quarter in which you become entitled to the credit. The premium in the employer or other entity entitled to the credit should also report any advance payments received in anticipation of the credit on the same 941. You should enter 0 on all remaining non-applicable lines, so any overpayment amount is the amount of the credit reduced by any advance payment received. So there are specific rules on how to use these forms depending on what your situation is, but the forms that will be used are the 941 and the 7200, depending on which one you want to do. If an assistance eligible individual fails to give you notice that they are no longer eligible for the COBRA premium assistance, which, remember, like Roberta said earlier, is going to subject them to a penalty, the employer or the premium payee is still going to be entitled to the credit received for that period of ineligibility unless they had knowledge of or should have had knowledge of that other disqualifying coverage or ineligibility. Because once the employer has knowledge of it or should have had knowledge of it, then they're not entitled to the credit from that point forward. So you're going to be relying on the self-certification, but you can't just deny that you should know something if you should know it otherwise. So that's an important situation. There are specific Q&As that address third-party payers and situations regarding third-party payers. I don't think that that's probably appropriate to get into detail on for this program, but the Q&A-81 and 82 under the IRS guidance that was just issued last week, and 83 and 84 all apply to third-party payers situations, like if you have a PEO or something like that. If an assistance eligible individual pays premiums for which they should have received the premium assistance, and they reimburse them for that amount, then you can still get a credit. It just changes the timing amount on the dates that you would be entitled to that. That pretty much covers all the rules regarding claiming the assistance credit. And the long and short of it is you're going to be using 941 and 7200 like you did for other credits provided to employers in relation to the COVID-19 pandemic. So moving on to our other topic, I'm just going to talk briefly about dependent care assistance and the increase in the limits. The annual limits on tax-free child care were increased, the $5,000 limit to $10,500. This is solely for the plan year beginning in 2021. So this year, for cafeteria plans that offer dependent care flexible spending accounts for employees, these increases have occurred. An amendment to your cafeteria plan to implement this change would have to be executed no later than the last day of this year. That change, coupled with the mid-year election change relief that was discussed, that was in prior guidance, can allow for mid-year election. You can allow for mid-year election changes to increase the amounts deferred. The IRS actually issued an additional notice, which was 2021-26, to explain the tax treatment of the dependent care flexible spending account benefits with these changes that are being allowed to the plans. Because now that you can carry over unused benefits from a plan year ending in 2020 to a plan year ending in 2021, and from a plan year ending in 2021 to a plan year ending in 22, or alternatively, if you have unused benefits remaining in a dependent care flexible spending account, that you can extend the claims period for a plan year ending in 2021 or 2020 to 12 months after the end of the plan year. So because they are kind of conflicting features that you can offer under these different pieces of guidance, they issued 2021 Notice 2021-15, which provides guidance on the implementation of the temporary ability to allow the DCAP amounts to be carried over into the next year or used for incurred for expenses in an extended period of time. So in Notice 2021-26, which is the most recent guidance, the IRS explains the application of those rules by giving 3 specific examples that are applicable to cafeteria plans. The first example talks about a calendar year plan, which matches most employees' tax years that offers dependent care benefits. And a covered employee under the plan elected to contribute $5,000 for 2020, but didn't have any dependent care expenses because in 2020, no one had dependent care expenses. The plan would allow the employee to carry over the unused $5,000 to the 2021 plan year. The employee elects to contribute $10,500 for the 2021 plan year, so the increased amount that's allowed, and incurs $15,500 in dependent care expenses in 2021, is reimbursed $15,500 by the plan. The $15,500 is going to be completely excluded from the employee's gross income because $10,500 is excluded as a 2021 benefit, and the other $5,000 is going to be attributable to a permitted carryover, which wouldn't count towards the limit, the $10,500 limit. When your plan begins on a non-calendar, when you have a non-calendar year plan, it's going to get a little bit more complicated. So if you have a plan year that begins July 1st and the employee contributes $5,000 but incurs no dependent care expenses, the plan allows the $5,000 carryover and they elect the full maximum amount of $10,500 for the plan year beginning July 1, 2021. The employee is going to have $15,500 available for dependent care expenses for the plan year beginning July 1st, 2021, but they don't have any expenses from July 1st through December 31st of 2021. Then they have $15,500 of dependent care benefits available as of January 1st, 2022. So in this situation, for the taxable year 2021, they're not going to have any benefits because none were incurred. For 2022, the exclusion will again be $5,000, and the employee incurs $7,000 in dependent care expenses during the period of January 1st, 2022 through June 30th of 2022, and is reimbursed the $7,000 by the dependent care plan. This is a much more complicated situation because you're going to have different limits and carryovers involved. And so in this situation, the employee would be allowed to have only the $10,000 worth of benefits excluded from their income for the crossover year, and any remaining benefits are going to be included in their gross income. And there's a third example that is going to apply based on different options that your plan can elect. So basically what you need to understand is that if you're going to implement any of these optional changes to your dependent care plans under your cafeteria plan, you need to understand how all of them work together. That's probably worth vetting out before you decide to make the changes to the plans. Will do it. And I think we've already answered the one question that I saw in here. Let me see if we have others.
I've typed in, I've sent answers to the questions that have been asked so far.
Okay, it looks like we've sent questions. Oh, it looks like here's a question. There's a question regarding a subsidized backup care program. If they keep their dependent care flexible spending account max election at $5,000, when determining the taxable combined dependent care benefit, would anything above 5K be taxable, or would it be anything above 10,500? I'm not sure I understand the question completely. Yeah, if you keep your max election at 5,000, then anything above that would be taxable. So you would have to increase it if you're going to use the, or want the higher maximum to apply within the cafeteria plan benefit. And we will also try and do answers to any other questions that are here and make that available as well when we post the program for recording. So if there are any other questions, you can go ahead and type those in now. We've got a couple minutes left over, and Roberta, did you have anything you wanted to hit on to kind of wrap things up?
No, I think we've covered it. Now there's a question: do the provisions in slide 11 apply to mini COBRA? I don't remember what slide 11 was about. But if it's the extended deadlines, if it's the extended deadlines for people to make like retroactive COBRA elections, those do not apply to state mini COBRA, because the Congress doesn't have jurisdiction to extend people rights under state mandated programs. So for the,
and is that also the case with the COVID extensions? I believe so.
Yeah, the Congress and the federal agencies cannot extend deadlines for state law governed programs.
Mm-hmm.
So the states, I gather that some states are considering their own extensions, but I'm not aware of any that have adopted them. There may be some that have adopted them. I just haven't gotten the word.
And it looks like there's one more question about whether or not a number of assistance eligible individuals can be reported now for the credit. And then what if we learn that someone's no longer eligible for the subsidy? So you can only get the credit for them when you're entitled to receive the credit. So it depends on where the period is and whether or not you would be entitled to be paid for the premium or not. You can't do the full subsidy period and get your stuff. You have to wait until you're entitled to claim the credit. You can wait until the whole thing is over, and you'll just be fronting the money for a longer period than necessary if you don't want to file multiple reports. And I think that's all the questions that I see there. So if you have any additional questions, you're welcome to submit them as you think of them via email, and we'll do our best to get back to you as soon as possible.
Yeah, I put our email addresses in the chat.
Thank you. Well, I think then, since we're coming up on an hour long, we'll go ahead and end the program. Thank you very much for participating. We appreciate the opportunity to be able to explain all these new and exciting things to you. And hopefully you've gained something from the presentation. So have a good afternoon.